Internal Controls, a guide for accounting students. Meet Terrence. He's the CEO of a major corporation. Today, he's explaining to his employees what internal control is and how it affects them. Internal control is a company's plan to safeguard the company's assets and improve the accuracy and reliability of accounting information. The Committee of Sponsoring Organizations of the Treadway Commission is dedicated to improving the quality of financial reporting through internal controls, and they have come up with 5 components of internal control, which include control environment, risk assessment, control activities, monitoring, and information and communication. Terrence takes a closer look and explains each to his employees. Top management sets the tone in the company for establishing the control environment. They are responsible for the culture. It includes assigning responsibilities and the organizational structure. Terrence explains the number 2 component, risk assessment, identifies and assesses internal as well as external risk factors that could prevent the company from meeting their objectives. Terrence asks Isabella in the accounting department to explain control activities. She says these are the policies and procedures that ensure management's directions are being followed. Isabella further explains that control activities can include preventive controls and detective controls. Mark is taking a closer look at preventive controls, which include separation of duties, physical controls, proper authorizations, employee management, and e-commerce controls. Stella, also in accounting, explains detective controls, which include reconciliations, performance reviews, as well as audits. Continuous monitoring of internal activities and deficiencies is necessary and must include formal processes for reporting these deficiencies. Moreover, companies must work to remove these deficiencies and strengthen their internal controls. Terrence explains the last component, information and communication. Employees at all levels must understand the need for high-quality information and that it must be communicated in a timely manner. So at the end of today's training, the employees want to know from Terrence who is ultimately responsible for making sure internal controls work the way they're supposed to. Terrence explains top executives must take responsibility for the effectiveness of internal controls. Management must attest to the accuracy and effectiveness of internal controls, and then the auditor must provide an opinion as to whether or not management's assessment is fairly stated. This is Section 404 of the Sarbanes-Oxley Act. Anita asked Terrence, if all these internal control measures are in place, why do we still have fraud? Terrence explains, no internal control system is foolproof. There are limitations to every system. For example, you could have 2 or more employees acting together to circumvent the system. This is called collusion. You could also have top-level employees who have the ability to override the internal control policies and procedures and commit fraud. Terrence reinforces that while these things exist, all companies must strive to have strong internal control systems. Terrence has had a successful day training his employees about internal controls. They are pumped, so he sends them off with a motivational message. Now go forth and lead. Thanks for watching.